Good morning, everybody, and a very happy 2026 to you. I truly cannot believe I'm already saying that, and yet here we are. Just as we let everybody in here, quick reminder about our disclosures. Everything that we talk about today, informational purposes only. You can see our full disclosures online, but this is just for us to get in touch with you as we begin a new year, and we're happy you're here. As always, we will be doing a Q&A session at the end of our presentation today. So just in case there's something that we don't talk about that's a burning question in your mind, or if you just want to interact with us, we are more than happy to do so. It makes this a little bit more fun for us as well. So at the very bottom of your screen, you will see a Q&A button. Go ahead and type your question into that box there. If we're not able to get to it today, not a problem at all. We have it on our end. We'll make sure that somebody gets in touch with you to make sure that your question does get answered, even if we don't have time to do so today. So, with that, I am once again joined by Jake MacFarlane, our senior research analyst. Jake, happy 2026.
Absolutely. It's good to be back. I missed the last one, and I'm glad I still have a seat at the table.
We'll see how you do today. It's not a permanent seat. So, but again, I'm Joel Johnson. We're very happy to have you here. Very important and a lot of conversation to have today. So let's just go ahead and give a little overview of what we're talking about. So Jake, go ahead, tell the folks what our key topics are for today.
Yeah, so if we are in a car driving down the road, we're going to spend a little bit of time looking in the rear view mirror and kind of give some context as for where we're at today, looking at what happened in 2025. We're also going to, of course, check in on our holy grail, and that's the certain economic indicators that are near and dear to our hearts, and kind of see directionally where are we heading on an economic basis. And then finally, we're going to look out the windshield, kind of look forward to 2026 and where we're headed. Of course, we don't have a crystal ball, and we don't think anybody else does either, for that matter. But we're going to talk about where things are at today and what we can expect to see in 2026 and how that might lead us to make some changes within portfolios here.
I'm very glad you brought up the crystal ball because I cannot tell you how many times we're going to sit in front of the clients for the next few months and say we would not have expected what we got in 2026. And we're going to go through all of that today. But when we had the same conversation last year, we always talk about what kind of expectations to set and kind of the range of outcomes. But it was a great year in the markets, even though it might not have felt that way. And so, for starters, let's go ahead and take a look at what the markets gave us in December. So, good month again. We jokingly say Santa went overseas because that green line at the top, our outperformer for the month, was actually the international markets. International markets started the year very hot. They've now ended the year very high. You see outperforming the other three domestic indices that we track there. The second best performer was actually the Dow, which kind of has more of a value tilt to it. So value actually sort of outperformed growth in the month of December. And you saw the tail off in growth, really kind of a pullback in the middle of the month, and then really towards the end of the year for both the NASDAQ and the S&P there, the purple and the blue lines. One of the interesting things really about December is the second half of the month really barely counts.
Yeah.
When you look at trading volumes, everybody's on vacation, everybody's off at Christmas, preparing for New Year's or whatever holiday that they're celebrating. And so trading volumes really do take a breather at the end of the holiday during that holiday season. So really the front half of the month is a little bit more important from a market perspective, but then we pick it up here as we start in January, which is where we've seen a little bit more volatility as we begin the year. But Jake, any comments about what we saw in December?
No, I think to your point, the only thing I would add to it is we didn't have a whole lot of corporate items happen either in the month of December. Not a lot of earnings to really talk about. So to your point, a little bit of volatility in the first half of the month, and then maybe some tax loss harvesting near the end of the month for folks who haven't been doing that, throughout the year. But I think as we go on to the next slide, Joel, we're starting to see. Not only was Santa, oh, I'm sorry, I'm getting a little bit ahead of myself here. I think, as I look back at the year, there were some major headlines that either popped up and had their place in time, or kind of were there and simmered throughout the entire year. And in many instances, it felt like 2025 was a bit of cross currents in that we had almost every major investing force pulling in one direction or the other. And Joel, I'll start us off here with kind of the early in quarter two, we had some tariff announcements, the sweeping U.S. trade policy that really shook the markets. A lot of uncertainty, and that headline was very prominent in the repricing we saw in April, where markets fell, especially risky assets like more growth names and the Nasdaq, let's say. They had a certainly a repricing and a correction there in April, but tariffs themselves became sort of a year-end phenomenon that popped in and out of, hey, we have more bad news on tariffs. Oh, hey, actually, it's better than expected now. Some of these are being reversed. And that was really an interesting one in terms of uncertainty from both what businesses are doing on their buying and selling, also in the markets as well. And it just became one that we ended up having the hindsight now that it sort of quickly corrected. But for a good bit there, it looked like we were heading for some dire streets in 2025.
Yeah, and some of the other headlines that we saw, AI, 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 it looks a little like ow, ow, ow there, but AI, 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 you could not wag a stick at a company's earnings report the entirety of 2025 without hearing AI multiple times. Campbell's Soup is going to talk about AI all the way up to Nvidia, the one that's most known for it. Everybody was talking about AI. Great, we should be buying domestic markets, right? Well, hold on. Dollar had the worst year it's ever had since 2017. Maybe we shouldn't be buying markets. Gold and silver were surging. They only do that when the fear index is high. Commodities really start to hit their stride, or you see kind of the repricing that they've had when fear is high. People are scared of the market. So should we have been moving into gold and silver? Geopolitical risks everywhere. Headline after headline about all these issues that we were seeing. Fear, fear, fear. Crypto's crashing. It got up to 120,000. Then it dipped down to 90,000. Rate cuts begin again. All of these headlines and things that we saw throughout 2025, if you focus on just one of them, like you really talked about there with the tariffs in April, if you had just focused on that and you had made investment decisions based off of them, you probably would have not experienced what a well diversified portfolio did in 2025 because you would have been moving in and out based off of whatever the headline of the day was. Our favorite thing to do as an investment committee and really as a firm is zoom out, pan out and look beyond the headlines and what actually happened in 2025. Jake did a great job of explaining that dip right there at the beginning of the graph. That's April. Liberation Day, Tariff Day, whatever we want to call it. That was the headlines hit. Here's all the tariffs. Here's all the bad news and how this is going to be terrible for the markets. And oh my gosh. But then look what happened for the rest of the year. The headlines worked themselves out. Overall, we still had a fantastic year across market cycles. If you were well diversified, the international part of your portfolio was actually up the most. International for the year was up almost 32% on the indice there. Domestic markets still had a great year. S&P up 18% virtually for the entirety of the year, and that's off the back of a plus 20% year that we had in 2024. Staying invested and staying in the market through the headlines is what makes the most difference when it comes to investing in long-term planning. Jake, you got anything to add to that as we look at what 2025 gave us there?
No, I think it is really impactful when you look at the headlines we had listed there of the eight of them. Seven were negative, and it is true that bad news sells, and headlines are driven by what people are naturally drawn to, right, with their eyes and what they want to consume. And if you are emotional about that, which is so easy to be, you are perhaps at the whim of making a bad move, right? And getting out of the market when the headlines are all negative. It's perfectly logical. But then, oftentimes it leads to really detrimental results on your portfolio. And we talked about some of these headlines, the Fed starting to cut rates, right? We saw that come through, and whether the market expected that or not, we started to get some easing on a policy standpoint, which certainly helps the stock market. You talked about the dollar having the worst year. That lends well to international investing, which certainly we saw come to light this year, and that had been a real lagger on portfolios for what, Joel, the last 20 years,
Yeah.
right? So, it would have been easy to say, hey, international hasn't worked. We're not going to invest there. And then, you're missing one of the top performing asset classes globally this year. So I think what you said is so on the mark in that you really need to have a diversified, well-balanced portfolio that can act as a ballast when markets are going through difficulty, but also have the upside as well, as we saw come through this year.
Absolutely. Absolutely. So if we looked at those headlines and we looked through those headlines, what actually drove the market? And so this is where Jake and I get a little technical and we start talking about factors. And what factors are is breaking down the overall stock market into groups or different groups of stocks that have different characteristics that drive their performance versus the company itself. So, for example, low volatility would be stocks sort of like a utility or an energy company. They don't tend to be as volatile as a high growth small cap company. And so you would group those together as low volatility. Growth, very similar. You're reinvesting a lot back into the company, tend to not pay dividends because you're in growth mode. So you're spending a lot. CapEx is high. Those would be what we call growth companies. And the momentum is just things like, unfortunately, the meme stocks a few years ago would have fallen into that bucket. Essentially, it's going up and the market's just going to keep it pushing it up. That's a very high level of what factors are. But this is what drove the market from a factor standpoint in 2025. And it was continued to be momentum stocks. These are not, I'm not saying these are just the meme stocks, but that's kind of what you're looking at there is if the stock has been moving up, will continue to. It's had that momentum upwards. That basket of stocks looking at it was up 27% of the year. That's what drove most of the outperformance. And if you go back to the last slide, that's exactly what we saw. NASDAQ outperforming a Dow Industrials, which again, the Dow Industrials would tend to lean more low volatility. The other one that we really like to focus on in a lot of our strategies, and then Jake, I'll send it over to you, is value. When we do our research on these companies, we are looking to pick up stocks at a good value. And over time, this tends to work well in our favor. But in a momentum-driven market, it will underperform. And it did. But setting expectations, you still got a 13% return. And again, panning back, you're looking at an 8 to 10% return, depending on who you're talking to in the S&P 500 or whatever that long-term return average is going to be. 13% is great. We should be happy with 13%. But when you're looking at the NASDAQ up 20 some odd percent, it kind of changes your perspective. But then we try to bring it back down and say, know what you own and why the dispersion, not just looking at the performance and trying to chase it.
Yeah, Joe, to me, the one that sticks out as well would be quality. And again, 13%, 13 and a half almost. That's a good year, right? But when you compare that to momentum, right? I think what you start to see in some markets, and we'll talk about this more within what kind of happened with small cap, but you begin to see a picture of quality would be, hey, these are great businesses with a good balance sheet and good cash flow generation. These are a lot of the characteristics we look for in companies. Whereas momentum, as you mentioned, Joel, is a lot more about trading volume and about the price momentum of the stock. If it's going up, it's going to keep going up. That would be the momentum sort of factor there. And so it's kind of beginning to build a case that maybe a lot of the stocks that had great performance figures weren't the most quality companies in nature. Sometimes you see the quality and growth kind of move together, but that deviation that we've seen here, when you compare it to momentum, it's half of the return there. That to me sticks out because you expect quality companies, when the market is up, those might be the one that benefit the most. But in this case, that certainly didn't happen. Although it was still, in an absolute basis, a better than average year in all circumstances.
Yep. Absolutely. Absolutely. So let's go ahead and just change gears for just a second here, and let's kind of look at the yield curve here and focus a little bit on fixed income. Not a lot to say from my perspective, Jake. I don't know if you have a lot of comments here, but the Fed does continue to cut interest rates. We saw another one. They may pause from here, but there is expectations for them to continue. It was a weird period because we also had the government shutdown, so they're supposed to be data based, but we weren't having data come in. So it was a kind of a weird 3 month period there, but they decided to cut interest rates once again. So you saw the short end of the curve, which is that blue line there. That's where we stand today. The very shortest end of the curve, which is what they can control the most, has dropped down below 4% on a total return basis. But the back end of the curve is actually getting a little bit healthier, which we'll also see in just a second. So the fixed income market is sort of shifting slowly, but getting healthier. So it's good signs, but we're going to have to wait to see what we get in 2026 as far as Fed rate cuts go.
I got nothing to add there, Joel. I think yeah, when you think about a healthy yield curve, it's one that is upward sloping, and so we're getting some that short end to come down a little bit as the Fed cuts rates. One thing that's interesting is they stopped the quantitative tightening, which is the Fed letting their treasuries roll off the balance sheet. They're getting towards just a neutral kind of standpoint there now. And so what that could do is affect maybe the intermediate to longer end of the yield curve. But we're getting a little technical there, and this isn't the most interesting chart that we have this month. So let's go ahead and move to the next one.
Yeah, I don't know if this is more interesting, but we like it. So this is, of course, is our holy grail that we love to revisit and just kind of get the health of the overall economy and where we stand. First one you're going to notice right off the bat there, housing starts is in the red. But if you look a little over to the right, it's because 3 months ago we didn't have a data point, and that all goes back to the weird little 3 month period we had where we didn't have this data coming in. The government was shut down. It's starting to roll in now, but what it's also doing, and you've heard a lot of folks talking about this, is potentially there's some, let's call it fuzz in the numbers that are being reported now. It'll iron itself out over time. It shouldn't be drastic, but it is something we're keeping an eye on as far as the overall economy goes. Other than that, the economy is actually still looking fairly good from a data dependent statistical standpoint here. Inflation continues to come down. The most recent reading there you see was closer to about, I think it was 2.5, a little at 2.5%, if I remember correctly. The yield curve, like I mentioned there, that Y is also green, the 10 and 2 year spread, the difference between the 10-year yield and the 2 year yield. We want to see that a positive number. People talk about it all the time when we see an inverted yield curve and what that means for the markets. We don't have one right now. So the market's not predicting anything here. So overall, from a data standpoint, there's some cracks and some things to be keeping an eye on, but there's nothing right now that's flagging red that says that we should be worried about the US economy moving into 2026.
Yeah, just one item that had been creeping up a little bit is at the very end, those loan delinquencies. We look, we're right around 1.5% now. A year ago, we are at 1.25%. So it sounds like a small difference, but on a percentage wise, a pretty big increase. However, over the last 3 months, that has come down a little bit. So more recently, a pretty good number to see there. And looking at the labor market, unemployment is something that's in the crosshairs, right? And that's what really was a spur to have the Fed start to lower rates, was to hopefully help on that segment as inflation, has kind of been coming down naturally. So those are kind of the ones that I would say I'm keeping my eye on. Of course, retail sales, as we start to get some more of the holiday sales figures in, we'll start to understand how that has evolved a little bit more. Because at the end of the day, we are a consumption-based economy. So if we have some pullback there on the retail side, that could potentially be the canary in the coal mine, or if that continues to be strong, that could be a really good base to look at and to getting into 2026 as, hey, the consumer is still strong, still willing to spend, and really it's hard to really pick a lot of holes into how the economy is behaving right now. kind of a maybe a slower growth environment, but still healthy and still showing real growth promise.
All right. So healthy stock market in 2025, relatively healthy economy moving into 2026. Let's now start looking out that windshield and start looking at some themes in the stock market for 2026. And Jake, I'll let you handle this here.
Right. So if I start on the first box, this idea of market breadth, and what that means is, do we have a market that has been driven by a lot of different asset classes doing well, or a lot of different types of stocks doing well, or have we had a narrowly driven market that only a couple stocks have really been doing much of the legwork on? So I think what we saw in 2025 was this improvement along different asset classes doing well. I mean, we showed the yearly number of international leading the way, and that had been a lagging asset class for a little while now. Even small cap did well. Not only that, but looking at the different companies. I mean, we talk about Mag 7, and before that was the FANG stocks. These were markets in 2024 and 2023 that were really driven by just a handful of companies that did exceedingly well. Those same stocks still did pretty well this past year, but other companies pulled their weight as well. I think as we look into 2026, that story sort of will integrate with the AI tailwinds box that's down there. And what I mean by that is last year we saw AI be a dominant force in the headlines, but there was sort of a shift. And in the back half of the year, it became, hey, every company's talking about AI and every company has a story, but investors sort of started to demand more. Like, hey, what is this doing for me and for the company? Is it leading to profit or not? And also, what are the maybe the non-technology names that are embracing AI? How is that helping their productivity or their margins? So I think as those two forces collide, we should get a good view in 2026 if this breadth will continue to improve, or if it will be sort of driven by just a few handful full names. And I think AI will be a big part of that story that we see there. The other thing that I felt was interesting this past year was that performance and was really impacted a lot more by profits than it was necessarily by multiple expansion. What that means is, a stock can go up and down based on, buyers and sellers. There's more buyers, the stock will go up, right? And what can happen is if there's more buyers based on sort of the narrative or the expectation that the company will do well in the future, what that might lead to is a higher price to earnings multiple. And so that can be a driver of stock performance. We saw that happen, maybe like through COVID, where a lot of these stocks started to trade very high in PE multiple, but their profits hadn't changed much. This past year, we saw profit increases of, broadly speaking, call it 10% for the S&P 500. And that was driven by not only revenue growth, but also these companies had margins that expanded. They got more efficient and did more with less. And I think that will be another crucial focus point to watch because the valuations are already pretty high. So I don't think there's still a lot more room for multiples to keep expanding because the AI story has already kind of been out there unless there's another exogenous event. But the crucial component will be, hey, are companies still able to grow their profits and figure out how to improve margins and still have revenue growth? Small cap rally, again, when we talk about momentum and quality factors, I think is even more prevalent within small cap companies. We saw a big year from the Russell 2000, which is the small cap index. And if you look under the hood a little bit, you'll see that a lot of these names are sort of settling within a couple different types of stocks. And so, for example, quantum computing stocks did really well. Biotech companies, a handful of those did really well. And so you're seeing these companies that are leading that market, in terms of quantum and biotech. These companies don't have, for the most part, any profits. They are operating at losses. However, they have a great story and a great expectation. Some might call it speculation, but certainly there is a measure that, hey, if you're picking stocks within small cap and you're basing it off of fundamentals and quality characteristics, you really had a hard time beating that market index in 2025. Typically, that just doesn't last indefinitely. There's a reason why fundamental investors have worked over time. So I'd be curious to know if that is a theme that has a lot of resiliency heading into 2026. And then I'll kind of speak on the last two quickly, Joel, and I'd love to get your comments on these if anything sticks out to you. We talked about gold and silver as having this resurgence last year. And to me, the framework that I will use kind of going into 2026, there's a couple of items I do still think could be supportive of gold and silver. Number one would be if real rates continue to decline, which we saw in 2025. But I think the big one will be on the geopolitical standpoint. We saw some of these risks come through, but they weren't exactly impactful on the markets yet. Maybe because they didn't affect supply chains or inflation too much. But I see a path forward where I don't know if the geopolitical risk abates at all, and potentially it starts to impact some of those data points. I think that could rear its head, which would be supportive of gold and silver. On the downside would be, hey, if we see kind of growth surprise to the upside and we get some appetite back in place for getting it back involved in equities, that could be a negative for gold and silver. And then lastly, looking at private markets and private equity overall, that's kind of been the big headline there is kind of from COVID, we had almost like a pause in buyout activity and private equity mergers and acquisitions. I think in 2025, we started to see that thaw out a little bit. And when I say that deal making has not returned to pre-COVID norms, I mean, that's a major understatement. Yes, it improved a little bit, but there's still a long way to go before we get back to what a normal private equity kind of buyout environment look like. Right now, companies are just staying private for longer, for better or for worse. So that's been an asset class that has certainly not done as well overall versus the public markets have. So Joel, with all that said, are there any things that kind of stick out to you there as being just really important as we look into 2026?
Yeah, I'd point out two. The first one, going back to your profit conversation. In 2025, you saw the momentum, you saw everything going on with AI. These companies, they are generating profits, they are generating a lot of revenue. But then when we got into pretty much Q3, Q4 earnings reports, you saw them still reporting those blowout quarters, but people started to become much more price sensitive. And so you actually saw some pullbacks, which we've talked about in some of our previous conversations here. And so it continues to be important to look fundamentally at these companies and not just buying the performance or the recent performance that we've seen in them, because eventually profits and revenue and all of the metrics that we know and love as analysts do come into play over time. And then just very briefly on the private markets, I couldn't agree with you more. Those companies that are being bought out, they are staying private for longer. Now, the positive swing to that story is that because it's just easier to operate in the private markets without all of the scrutiny of being a public company, and so you're able to invest with a longer time horizon, certainly something to that. On the other side is you don't have the scrutiny of the public markets. And so there's a give and a take there. And so whenever we talk about private markets with our clients, we always go in very cautiously, make sure that you know what you're getting into, because they aren't risk free, of course, as all equity isn't. And so we want to make sure, as always, you understand what you own, especially when we start foraying into things like the private markets. So, with that said, on the investment standpoint, how about some planning themes for 2026? So, switching gears a little bit and talking about overall financial planning. Real easy one right off the bat. Would love for you to review your cash flow from 2025. No, I'm not asking you to do a budget. That's something that I enjoy doing for my family. My wife hates it. If I asked her to do a budget, it would never happen. I expect it's very similar for many of you. But what we do want to do is, very broadly speaking, did the expenses and the income that you expected in 2025 match with reality, or were there any big swings one way or another? If there were, let's talk about it and make sure those aren't persistent and get your plan updated. Will 2026 bring any major milestones? Births in the family, kids or grandkids, marriages, any big life events that are going to be coming up? Do a quick review, kind of plan out the year, take a look at it. That way we can line up your portfolio to your specific situation and make sure that we have the cash flow available, ready to go when that event, that exciting day does eventually happen. If you have required minimum distributions, what are they and what is the plan for them? Two things have happened over the last probably 5 years or so that we've gotten more clarity on over the last couple here. One is a lot more people have RMDs than they might have thought 2 years ago. If you've inherited an IRA from a loved one, you may or may not have a required distribution from that account. We want to make sure that we're getting the money out if we're required to, because there are penalties for doing so. And if you're turning 73 this year, or you've been 73 for a while, of course, we know that you do have required distributions, but there are still things that we can do with those required distributions from a planning perspective that we'd love to talk to you about. So make sure you get those reviewed and make sure that that money comes out so that we're not penalized. The big one here, the One Big Beautiful Bill Act, which was passed just a few months ago, changed the planning landscape from both a tax perspective and an estate planning perspective. The biggest misconception I've seen with folks, especially in that ultra high net worth area, is that because they extended the estate credit, how much you're allowed to leave at your passing, we don't have to do any estate planning anymore. We're fine because it's such a high limit. Moving into 2026, it's $15 million. That's not a lot of people reaching that level. Does not mean there is not still estate planning to do. So if your estate plan hasn't been reviewed in at least the last 5 years, please make sure you do that and that we update it, because that also does apply to IRAs. Also, with the One Big Beautiful Bill, we did see changes to charitable giving that beginning 2026. We want to make sure that you're aware of. A lot of other nuance there from a tax filing perspective. So a lot of changes moving into 2026 that should have you reviewing your situation and making sure that we're checking all of the boxes that we need to. Going back to the portfolio management side of things, just real quick, like we just spent the last 35 minutes talking about, we had another great year in the markets. Domestic did great, international did great, even fixed income did really well in 2025. We want to make sure that going into 2026, we rebalance that portfolio and bring you back into line with your risk tolerance, because at some point, when we see the other side of that coin, we want to make sure that we've set you up for long-term success and got your portfolio exactly aligned with where we want you from a long-term planning perspective. Because where we've seen most folks make the biggest mistakes in long-term planning is a disconnect between their long-term plan and their current portfolio. And most of the time, that's because of tax consequences, reluctance to sell, or chasing performance. So please make sure you're reviewing that as we go into 2026 with a strong 24 and a strong 25 now in the rearview mirror there. And just one more time, moving into 2026, tax planning. We are not CPAs, we are not tax experts, but we do know the changes that have kind of been created for 2026 that we want to make sure that you're aware of. So please get a hold of us if you'd like to talk through your particular situation and make sure that we have your plan on track to make sure, again, we're checking all of those boxes as we're entering a new tax regime in 2026. Jake, I'll throw it to you. Anything quick come off the bat is important before we move on?
Yeah, I just think that, we've had 3 great years now, and especially if, you've been buying individual stocks like we do, right? You've got these darling positions that have done so well now for 3 years. They might be taking up too big of your portfolio, and that reluctance to sell is a real thing. Just know, like, hey, Number one, you have a tax penalty that maybe we can do some tax loss harvesting to offset it. But that means that you did well, right? You bought a stock and it increased in value. Um, that is a lot better situation than getting into a correction period where that stock is impacted more because it's done so well and is trading at a high valuation and comes down on you, 30-40%, on an oversized position in your portfolio. That's a really tough place to be. So I know it doesn't feel great. There's a lot of friction there when it comes to selling a darling position, or at least trimming it back to sort of where it should be. But it's so crucial for you on a long term perspective.
Absolutely. Yep. Don't let the tax tail wag the dog. That's what we always say around here. So, with that, everybody, thank you again so much for joining us during our conversation today. We're going to now move into the Q&A, but before we do that, as a reminder, as always, if you know somebody that you think would value this conversation or would like to participate and get some of their questions answered, please let us know. We are more than happy to have them join us. We'll send them a link. Feel free to send it on your own. You'll get the replay. Share it however you want. The more that we get involvement, the more fun Jake and I get to have with these conversations. So thank you so much for joining us, and let's go ahead and flip on over to our question and answer session. All right, and good morning, everybody. Again, happy 2026. Glad you could join us today. We did have a couple questions come across, so we're happy to jump into those. Jake, you want to kick us off with our first one there?
Yeah, absolutely. We had a question come in about the market and question come in more about government policy and data. So, Joel, why don't we start there? And I'll kick this one off to you. The question was, how confident are we on the accuracy of the data that's coming out from the government? That could be, CPI, jobs reports, GDP. Seems to be some revisions there. So why don't you kind of walk us through kind of our best thinking in that department?
First off, oof, let's start with a hard one, huh? Um,
Yeah.
well, so it's as accurate as we can possibly get, right? It is their best guesses. They've gotten really good at this over the year, but what you'll notice is once the initial numbers come out, we always get those revisions. And so very typically we're close when those initial numbers come out, and then we'll have revisions one way or another. What we're really looking for is no big swings in the revisions. If we see big swings in the revisions, we start to trust it less. For the most part, we don't get large revisions one way or the other. I think where it's a little more complicated is what those data points actually mean, because what you'll hear talking heads on TV say that they mean might not really be, because they're trying to do it in a very short clip. We saw the jobs report came out and unemployment went from 4% to 4.3%. There's a whole lot more underneath that jump in 0.3% than they're going to be able to get across in that segment. For example, there's the labor participation rate. If there's less labor participation, that affects the unemployment rate. So depending on how that swings, so it's much more amorphous than it is just a straight number that they're getting at. They're certainly very valid data points. That's why we look at them, but we don't make judgment calls or investment decisions specifically based off of any one number or on the accuracy of any one number. It's not like we trust CPI more than the unemployment rate at all, but we take it all into context when we're making investment decisions. So Jake, I don't know, hopefully you agree with that, but feel free not to.
No, I do. I think when you start to look behind the curtain on how a lot of those data points are what actually goes into them, maybe your appetite sours a little bit on, the general usefulness of each of those. However, it gets people talking, and that's for sure. But it is something that we monitor, especially I would say like the magnitude of the revisions. If it comes to a point where we just don't have confidence in the number that's being reported because we think it's going to be revised to a completely different magnitude. And that standpoint, we would heavily scrutinize that data point and probably use it less.
Yeah.
So a really great question. Another one that we had come in, Joel, and I'll let you take this one again since you maintain that holy grail chart and dashboard that we look at. as you are looking at the different indicators, are you populating that on a daily basis, a weekly basis, quarterly? Walk us through just your process quickly there.
Yeah, another great question. So what we're doing with that Holy Grail is we do keep an archive of what they were in the past, but every time we look at it, we compare it to a new data point. So just for example, CPI, we'll compare that to the most recent CPI reading, and we won't compare it to like the one that was two readings before that. We're for each data point, it's a little bit different. It might be 12 months ago, it might be 3 months ago. It depends on what the data point is. But every time we're refreshing that dashboard, we're comparing it to a new comparison number. We don't pinpoint it kind of like CPI does to it started at 100 and it moves up. We don't do it that way. We just want to see the trend of each of these data points rather than just a single point in time. We're trying to look for the trend and where that data point's going.
Yep, well said there. We had another question come in, really more about market. So I'll take this one, and then Joel, happy to have you chime in there too. But just about, is the market expensive? Are valuations now justified now that earnings are catching up? We talked about profits being on the rise there. That's certainly true. Profits have been very steady and have shown a good amount of growth in the year of 2025. However, the market is still expensive relative to recent history. The S&P 500, for example, kind of most commonly quoted market, is trading a little bit higher than 22 times earnings if we're looking at a forward price to earnings ratio. If we compare that to maybe the last 20 years or so, it has averaged around 16 to 18 times, let's call it, depending on the different point in time there. But so we are a little bit higher than that. We're not quite as high as some of these like bubbles that we've seen. For example, the dot-com bubble got up to over 25 times earnings. And even more recently, as we kind of came out of COVID, where prices really outpaced earnings growth, we were around 24 times earnings there. So on the expensive side, relative to recent history, but not quite as extended as some other time periods that we've seen. But also, I would just remind everybody, it's a stock market, but really we look at it more like a market of stocks. If you go into Publix or any supermarket on any given day, you'll see some items that are on sale and that are at discounts to their normal prices. Sometimes I walk in and my boys love to eat strawberries, and sometimes the strawberry prices when they're in high demand, they're really expensive. And so there's some stocks that look a lot like strawberries and are very expensive, and they're a little bit more risky on that side. And there are stocks that we're still able to pick up at attractive discounts. So that's
Yeah.
what goes into our philosophy around building strategies and building portfolios. Is we're trying to look at really great companies that are trading at a discount to their intrinsic value. But if you just look at the broad market as a level of context, it is a little bit extended from where we typically see it trading at.
Yeah, I think it's a great point. I really want to pick on that about the market being the expensive part, is because, again, it's just one of those things. You just got to dig a layer deeper on what that actually means. When we talk about it, we're typically talking about that price to earnings ratio. That's the one that everybody's known and loved for forever. That's the one we compare it to. We're at 20 some odd. It's been 18 historically, whatever that means. When we're doing that, that is a weighted price to earnings ratio in the S&P of all of those underlying holdings like Jake just talked about. It's a market of stocks, not a stock market. So when we're looking at our companies and we're doing the fundamental research, we're looking for those values. So yes, you might have those large cap tech stocks that right now make up a significant portion of the S&P 500, and all of them are trading at very high PEs because they're considered growth and people think that they're going to continue to earn enough to justify it. But then you'll look at the strawberries, and those are going to be trading at attractive valuations that we can continue to pick them up for and make good sense for our clients to own long term. Even though the market overall is still expensive, there's always opportunity to be putting money to work. That's why we time in the market, not timing the market. So great point on that one. And then we had a couple more questions on the Holy Grail chart. I got two of them. So how often do we update it? And then why don't we have it on the website? We update it once a month. So every time we do one of these presentations, at a minimum, If we see big swings in the market, we'll take a quick look at it. And then I know Jake and Scott also have our big economic review coming up as well. They use the data points as part of that. So you might not see the actual chart, but certainly a lot of the same data points will appear in their presentation. And then why is it not on the website? Mainly because Jake and I aren't programmers. No, I'm kidding. The data feed that we use to get that into the presentation format that you see is a little bit more manual than it would be to have it feed into a website on a live basis. I think it's a great suggestion. I don't see why we wouldn't look into that. But it does tend to be a little bit more manual than just something that we would live feed on a daily basis. So that's why it's not there. So great question, though, and actually a really good suggestion. We'll definitely look into it. So I'm at the end of my list here. We're right up on the time. We try to keep these to about 45 minutes here. So, Jake, anything else before we sign off?
No, I've got nothing. Go ahead and take her away, Joel.
All right. Well, then, everybody, thank you so much for joining us again. We're going to be back here next month. I hope 2026 is off to a great start for you. Please join us again in February. And one more time, if you know anybody who would benefit from these conversations and would like to have their questions answered live with Jake and myself, feel free to send them a link or feel free to reach out to us. We're happy to get them involved. Thank you so much. Happy 2026.
Take care.